Freeze the frame. Date stamp it. February 13, 2026. Yesterday, global markets suffered a $3.6 trillion wipeout. Silver was crushed 10%. Gold dropped 3.76%. And right on cue, the media machine called it normal risk repricing. Normal? A 10% silver collapse in one session right before CPI is not normal. It is a signal flare. Tonight, we are not doing pundit talk. We are running a forensic investigation. This is a crime scene, and the tape is evidence. Because in real markets, chaos has fingerprints. Who sold size into thin liquidity? Who absorbed forced selling? Who needed the price lower before the data print? Who turned retail into exit liquidity? Here is the core thesis. What happened on February 12th was not an accident. It was a coordinated market crash built on technical pressure, algorithmic flow, and calendar timing. It was designed to trigger a liquidity cascade and transfer inventory from weak hands to strong hands. We investigate through 5 pillars. Front-running CPI. Crash first, accumulate cheap positions, monetize after data. Shanghai closure. Hit paper prices before Eastern physical demand steps offline for Chinese New Year, February 15 to February 23. SLV arbitrage pathway. Use discounted paper vehicles to improve physical coverage and patch short exposure. Technical breakdown map. 150 EMA hourly as ceiling, $74 as decision zone, $64 as downside magnet if support fails with acceptance. Physical versus paper divergence. Western paper falls, Shanghai premium widens near $7. Demand says one thing, paper says another. And then the warning label. The setup may not end in February. It may be laying tracks for a March squeeze if paper pressure collides with persistent physical demand. This is not fear content. This is pattern recognition in a maturity wall regime, where refinancing stress and liquidity games are now the operating system. So ask yourself one question before we start. Are you trading reality, or are you trading the story sold to you after the move is already done? Let's pin the evidence board. If you've watched enough tape, you know the difference between natural repricing and engineered flow. Natural repricing rotates. It tests both sides. It leaves room for discovery. Engineered flow does one thing. It compresses uncertainty into one direction, fast. That is exactly what February 12th looked like. Cross-asset damage wasn't isolated. It was synchronized. Risk assets got hit broadly. Metals got smashed. Correlations tightened at the worst possible moment. That is textbook liquidity stress behavior. Except this time, the sequencing looked too clean to dismiss as random panic. Crime scene marker number 1, velocity. Silver down 10% in one day is dramatic. But velocity inside that day matters even more. The move came in a concentrated wave, not a gentle bleed. Concentrated waves usually mean one side of the book was forced to move, and then forced to move again. That is how a liquidity cascade ignites. Initial sell pressure attacks weak structure. Stops trigger below crowded levels. Slippage widens. Margin calls force additional selling. Late participants panic and hit market orders into vacuum. At that point, the move becomes self-feeding. You don't need a million new sellers. You need fear and leverage in the same room. Crime scene marker number 2, sequence. The order of operations matters more than any one candle. First, structural pressure at technical fault lines. Second, acceleration through stops. Third, narrative panic after the damage. Fourth, selective stabilization while confidence remains broken. That sequence doesn't look like organic repricing. It looks like intent. Crime scene marker number 3, timing. Why do this on February 12th? Because CPI drops on February 14. Pre-positioning the day before a high-impact inflation release is not exotic. It's standard smart money behavior. What is unusual is how aggressively the tape was forced. If you can trigger fear before the print, you can accumulate cheaper optionality into the print. If CPI surprises your way, you win. If CPI surprises the other way, you still own better entry and better structure than the crowd. Either way, you're prepared. The crowd is reactive. Crime scene marker number 4, beneficiary profile. Who benefits from a forced liquidation event? Not long-only retail, not late momentum chasers, not anyone trading headlines. The beneficiaries are desks with balance sheet depth, execution speed, and cross-market plumbing. The kind of desks that can simultaneously pressure one venue, absorb in another, and hedge the narrative with derivatives. That is why it was just risk off is too shallow. This wasn't just fear, this was architecture. Now we move from evidence to mechanism, how CPI timing and technical structure were used as the trigger system. Pillar 1, front-running CPI. Tomorrow's CPI print is the obvious macro catalyst, but professionals don't wait for catalysts to happen. They position around how others will react to the catalyst. That is the edge. Here is the playbook in plain English. Force downside before CPI trigger weak hand liquidation. Absorb distressed flow. Enter day-to-day with inventory and optionality. If CPI comes hot, downside continuation can pay. If CPI comes soft, reversal can pay. Either way, the desk that forced pre-data positioning has a better seat at the table. This is why calling yesterday a response to data is wrong. There was no data yet. It was a response to expected behavior around upcoming data. Now layer in technical structure. The 150 EMA on the hourly chart acted as resistance, the ceiling of confidence. Every failed reclaim under that average reinforced bearish control. Once the market repeatedly fails at the same dynamic level, systems start leaning into that failure. Discretionary sellers join. Long conviction decays. Stop clusters build beneath support. And when clustered stops sit under support, you don't need much to start a chain reaction. This is where people misunderstand technicals. Technical levels are not magic lines. They are behavioral magnets. They concentrate decisions. Concentrated decisions create concentrated liquidity. Concentrated liquidity attracts predatory flow. That's why the tape looked algorithmic, because it likely was. Algorithms do not feel fear. They feel structure and liquidity density. Now the key levels. $74 equals critical support / decision zone. $64 equals likely downside pocket if $74 breaks and acceptance confirms. Important. One fast spike below $74 is not confirmation. Confirmation requires acceptance, time below, failed reclaims, and offers capping bounce attempts. If $74 fails cleanly, $64 becomes realistic fast. If $74 fails and immediately reclaims with force, that failed breakdown can trap fresh shorts and ignite a reflex squeeze. So the question isn't, is this bullish or bearish? The question is, what is the market accepting? This is the difference between opinions and reading the tape. And now we come to the most controversial pillar, the SLV pathway and paper to physical extraction logic. Pillar 2 and 3 intersect here, Shanghai timing plus SLV arbitrage mechanics. Let's start with calendar warfare. China's market heads into Chinese New Year closure from February 15th to February 23rd. During that window, immediate participation from a key physical demand region is reduced, not eliminated forever, reduced in real-time responsiveness. If you are a Western desk trying to pressure paper prices, when do you strike? Before CPI, before holiday closure, before physical counterflow can respond at full speed. That timing is not accidental, it is tactical. Now the plumbing. Most retail traders still think silver is one market. It isn't. There is paper silver and physical silver, and they can diverge violently for periods. Paper can be pushed quickly through futures / ETF flow. Physical responds through availability, premiums, and settlement frictions. This is where the SLV arbitrage thesis enters. Paper silver gets discounted under pressure. Sophisticated desks acquire cheap paper exposure. Redemption / settlement pathways are used to improve physical positioning. Short side stress gets reduced without chasing open market physical at worse prices. In neutral language, this is sophisticated arbitrage, exploiting dislocations between instruments. In predatory execution, where tape pressure is amplified to force panic selling and source cheaper inventory, it behaves like sophisticated spoofing at structural scale. Notice the nuance. The vehicle can be legal. The game can still be predatory. Now add naked short pressure. If institutions carry heavy short exposure in paper while physical demand remains firm, they face a trap. Covering into rising price is expensive, so they need a flush. They need weak holders to sell to them. They need price lower temporarily to improve long-term positioning. How do you get that? You trigger fear, force a cascade, and let leverage do the rest. This is why a brutal down day does not automatically mean the strong hands are bearish. Sometimes the strong hands are the buyers, just not at visible moments and not on your timeline. Retail tends to buy confidence and sell fear. Professionals engineer fear and buy flow. That is why this channel keeps repeating one line. Do not confuse violent prints with truthful prints. Now let's examine the contradiction that makes this whole case hard to ignore. Physical demand signals stayed hot while paper was melting. Pillar 5. Physical versus paper divergence. Western paper prices fell hard. Shanghai physical premium widened to around $7. That single contradiction should stop you in your tracks. If demand truly collapsed, physical premiums would compress. They widened. So what does widening premium during paper weakness imply? Local physical buyers are still paying up for real metal. Paper markets are expressing leverage stress more than spot physical reality. The dislocation is active and unresolved. This is not a small detail. This is the center of the case. Because if paper says cheap and weak, while physical says tight and bid, one side is lying about equilibrium. And usually, in stress windows, paper can lie longer, but not forever. Why can paper diverge so violently? Leverage can amplify paper moves quickly, stop-outs force indiscriminate selling, market makers widen and step back in thin conditions, narrative feedback loops attract emotional flow after the move. Physical is slower, stickier, and location-sensitive. You don't fake bar demand with social media sentiment. Now tie this back to Shanghai closure timing. If Eastern physical venues are entering holiday mode, immediate arbitrage pressure that would normally yank paper and physical back toward each other can weaken temporarily. That lag creates a window where paper can overshoot downside while physical stays stubbornly tight. That is exactly the setup smart operators want. Temporary dislocation plus public panic plus upcoming macro catalyst. And now the forward risk, March. If physical demand remains firm and paper short interest remains crowded after CPI and holiday normalization, the market can transition from suppression phase to squeeze phase quickly. Not guaranteed, but structurally plausible. This is where analysts like James Turk have warned about squeeze dynamics. Too many claims chasing too little trusted deliverable confidence. Whether you agree with every detail or not, the directional risk logic is clear. Persistent divergence plus crowded positioning is unstable. Unstable structures do not resolve politely. They resolve abruptly. So no, prices down is not the end of analysis. It is the beginning. Now we move to the only section that actually protects people, the playbook. Final playbook. March squeeze warning plus capital preservation. First, scenarios, not predictions, scenarios. Scenario A, $74, holds, failed breakdown, reflex rally. If silver probes below $74 and quickly reclaims with strength, especially reclaiming the hourly 150 EMA afterward, odds increase that the breakdown was a trap and inventory transfer is largely complete for now. Signals to watch. Fast recoveries after sub-$74 probes. Strong follow-through on reclaim candles, improving bounce quality. Shorts failing to extend downside on bad headlines. If this appears, reflex upside can be violent because late shorts are trapped and underhedged. Scenario B. $74 breaks with acceptance, slide towards $64. If price stays below $74, fails reclaim attempts, and keeps getting offered at lower highs, then continuation towards $64 remains the clean path. Signals. Repeated rejection at former support. Weak bounce depth. 150 EMA remains hard ceiling. No evidence of real absorption under pressure. In this case, fighting tape because a chart looks cheap is expensive bravado. Scenario C. CPI whipsaw and positioning shock. The CPI print can produce two-way violence, where both sides are briefly wrong. Here, reaction function matters more than the number itself. Hot CPI plus no new low in silver equals potential hidden strength. Soft CPI plus failure to reclaim structure equals potential hidden distribution. In short, price behavior after data is more informative than data alone. Now the March squeeze warning. If this week was an engineered flush into reduced Eastern participation, then March becomes the stress chamber when participation normalizes and positioning imbalances are exposed. A squeeze doesn't require universal bullishness. It requires crowded shorts and degraded exit quality. What could trigger squeeze conditions? Persistent Shanghai premium physical tightness, repeated failed breakdowns in paper price, sharp reclaim above technical ceilings, forced short covering into thin offers. That is squeeze geometry. It doesn't ask for consensus, it asks for mismatch. Now the non-negotiable part, capital preservation. Don't catch falling knives is not a cliche. It is a survival rule in manipulated liquidity environments. Capital preservation protocol. Define invalidation before entry. If your level breaks and structure confirms, exit. No heroics. Reduce leverage. High leverage in a cascade market turns analysis into noise. Scale, don't slam. Build in tranches around structure. Keep dry powder. Respect regime filters. Use $74 and the 150 EMA hourly as objective gates. Demand base formation before aggression. If there is no base, there is no edge, only adrenaline. Protect liquidity first. Opportunity is useless if you are forced out before it arrives. In a maturity wall regime, your first job is not to be right. It is to remain solvent long enough for asymmetry to pay. Let's close the case. February 12th printed a clear forensic chain. Motive. Preposition before CPI. Timing. Strike before Shanghai holiday closure. Method. Trigger a liquidity cascade through technical pressure. Mechanism. Paper dislocation and probable cross-venue arbitrage behavior. Contradiction. Physical premium widened while paper fell. Implication: suppression risk now, squeeze risk later. That is not random chaos. That is coordinated structure. Final verdict: if you only follow candles, you'll follow fear. If you follow flow, timing, and settlement signals, you'll see the transfer. Smart money does not need your agreement. It needs your panic. Do not provide it. Read the tape. Respect the levels. Track the premium divergence. Wait for base before size. Protect capital before prediction. And keep asking the only question that matters in every violent session.